so much for taking the time out to attend this session today. I hope you find it useful. We'll be very happy to answer all the questions at the end of the session. And before I proceed, happy Women's Day to all. May we all grow together, learn together, and make our lives a lot more fruitful. The same applies to all the men also in this session. So let's get on to it. This is one of the most important aspects of the entire financial planning process. Tarak, this is Mr. Manoj has raised hand. Mr. Manoj, is there an issue? Are you able to hear us?
Ma'am, maybe it's by mistake.
Okay. Yeah. So this asset allocation is something we really need to understand. We are very familiar with topics on financial planning. We need to do it in a very structured way. We need to plan for it and all that stuff. But where the core of it lies, the entire process revolves around where your money actually goes into. It is something that requires a conscious thinking, conscious approach initially. There are different ways to do it. It all boils down to how you look at it. So it's a combination of factors. We'll try to simplify it and try. The objective of this session is to make you think through that what I have done till now or what I plan to do, is it really going to help me achieve my goals? That is the end objective for all of us going through all these effort and pain. So that would be the focus of this session. So all of us may be investing across various asset classes. There are many that are not mentioned here, like fixed deposits, your PPF. You may be in stocks, bonds, real estate, cash. Typically, as we Indians, we love property. So a lot of us have a lot of most of our allocation, maybe more than 50%, if you see in terms of a value, would be more into the property, into our current real estate. So the first thing is, as I may keep repeating during the session, is this asset allocation working for me or not working for me? We wouldn't realize it till the time of the actual goal. So this is something that makes it all the more important why we should impart a conscious approach to it. All of us do. Many of us, once we start working, we put money here, we put money there. We don't think through whether what I'm doing will the returns combination, the risk that I'm taking, is it really going to help me achieve the goals? So we know that every asset class gives us gives us different kind of returns during different time periods. These are just two data points of the recent past. One is a very recent ad in ET Wealth that I thought I could put. So if you see the chart below, equities has performed in the year 2017, 2014, 2023, and 21. In some, gold has done extremely well in 2024 and in 2020. So different time periods, even real estate did very well between 21 and 23. So different time periods, different asset classes do well. And that's the whole the reason why we try diversifying our assets. If we can't afford to stay in one particular asset class at all times. But while doing it, it's more out of academic interest also. Try understanding if any asset classes negatively or positively correlated. Typically, they will not be positively correlated. Gold typically does well when gold or commodities will do well in a different scenario, and equities may do well in a different scenario. But if you want to get into the detail, within an asset class, you need to understand, like suppose you take Nifty and Nifty mid cap as a category, they have positive correlation. I don't have data point to show this, but I have seen it myself. So within an asset class, just make sure you may be putting money into Nifty mid cap also, Nifty also, by thinking that, okay, if one category does not well, but they're positively correlated. I'm not saying one is right or wrong. I'm just saying be aware of it. So when does we know that each asset class gives returns at different kinds of returns and perform differently. So when does each asset class, I've given for the main four categories. So fixed income typically does well in a falling growth or a recessionary kind of scenario. That's when markets could be volatile, markets may not perform. So people, so more from a capital preservation point of view, stability, fixed income typically does well. And also, if it is a long-term paper, long-term bond papers, the interest rates would already be fixed. So as the interest rates also start coming down, the price of the ones fetching higher interest rate would do well. So fixed income as an asset class typically does well in a recessionary kind of a scenario. For equities, it should be supported by a strong economic growth, good numbers, low interest rate. So why does equities do well in this particular scenario? Typically, when the economy is doing well, consumption improves, there's a lot of investment, there are a lot of growth in jobs. There's typically a valuation expansion that happens. There's a lot of positivity, expectations that the earnings would continue to improve. So there's a lot of buying demand. So typically, equities tends to perform in a buoyant in kind of an economy. It also does well when there's inflation is slightly going up. Commodities does well again in an inflationary scenario. There's a good economic growth because the demand for commodities is very high. And when we say commodities, we here it would more imply on metals also. When there are supply shocks or there's some geopolitical instability, especially for gold and silver, they do very well when there's some kind of macro or geopolitical issues prevailing. Why do they do well? Because again, the cost of inputs go up. They act as a strong hedge, especially gold and silver. When you have, like given in the current scenario, tariffs, wars, they act as a very good hedge. There's limited supply. The supply shocks act as a reason, as one of the reasons why commodity prices start going up, and strong demand scenario. Real estate, again, economic expansion and interest rates should be low typically. Why? Because in a rising wage scenario, people are motivated to get into that additional purchase, and low interest rate makes it more affordable for people to consider. So this may be academic, but it is good to know why, when, which asset class would be doing well. So there are different types of asset allocation. One is strategic asset allocation, one could be a tactical asset allocation, one is dynamic asset allocation. Many of you may be invested into dynamic asset allocation funds also. So what is the difference? Strategic asset allocation is more goal based and a little more on the passive side. So it's a static approach. You broadly decide that this is what it is. Because it is goal based, you have a sense that this kind of an asset mix will help me achieve that goal, right? So it is something you try following it most of the time till you keep meeting your goals. There is a diversification of portfolio. You focus more on risk adjusted returns. It's a static approach. It's very good for long term investors, and I would say it's the most tax efficient. Tactical asset allocation is where you try to capitalize on short term opportunities. Sorry. You try to capitalize on short-term opportunities. You see, oh, there's a movement here. Let me move this asset. Let me move cash flows to this particular thing. You need to be a very active investor to do this. You need to understand all these asset classes well. You need to get in and get out fast. So tactical asset allocation, many of them do it, but it's good if it's more prevalent amongst very seasoned investors who are able to foresee an opportunity, who are able to predict things. So if you belong to that thing, this tactical asset allocation would work for you. Typically, most of us are so busy in our jobs, so busy in our own careers. It's until and unless you really have that kind of an interest in the markets, interest in the different asset classes, it's difficult to do that. But it still works. We know many seasoned investors who do this. Dynamic asset allocation is where you keep rebalancing the weights or across different asset classes based on how they are performing. Uh, this has a proven record to beat the main indices, especially these balanced dynamic asset allocation funds. If you take the last 10 to 15-year track record, they have proven record to show that they have beaten the broad indices. So they keep rebalancing. Like, for example, a simple balanced advantage fund can have anything from 30 to 65% into equities. So if the valuations have peaked, they may bring down the equity allocation to 30, and when the valuations correct, they may again start increasing it. So they automatically keep rebalancing. So it's a combination of AI as well as a fund manager's call. So these are the different ways. What is the focus of this particular session would be only on strategic asset allocation. End of the day, we are doing all this to meet our financial goals. Okay. Most of us don't have the time to keep to be very actively involved. So if we have a structured financial planning process, if we have a thought through asset allocation strategy, we don't need to worry on many things, especially if you're a long-term investor. So the focus of this session would not be on tactical asset allocation or dynamic asset allocation. We would be focusing only on strategic asset allocation. So the questions we would be trying to answer is, how have I diversified my investments? What is the risk and return that I'm getting because of this diversification? And is it helping me achieve my financial goals? So our focus would be on strategic asset allocation. So the first thing, so let's start the process. First thing you should ask is, if you have not done it already, is put down what are all the assets that you hold. It could be a simple savings bank balance. It could be your monthly deposits, your RDs, your PF, your PPF, your gold, your sovereign gold bonds, equities, mutual funds, everything. Put down everything and allocate a percentage to it. Next question you need to ask is, why do I own this asset? If you went and bought an insurance policy, did you need it? Did you understand it? Did you do it for a tax purpose? Did some agent convince you to do it? How does it fit into your overall thing? When would this investment actually help you? So this is a good question to ask yourself. Why do I own this asset? That's true for gold. That's true for practically every investment. Third, is it helping me build my corpus and achieve my goals? There are many investments. I don't want to get into details and specifics, which probably are not giving us very good returns. But practically everybody gets into, especially if you say take something like an insurance plus investment kind of an option, returns are not great. It's 5 to 6%, but they do give you a life cover. They do give you a cover, and they do give you that sense of stability and security. So, but would it really help you build that big corpus? Not sure, maybe not. Do I need to change my current asset allocation? That is something you'll probably, if you go through this process and think through what you have done and try after you have done your goal part, you will be able to answer. But by the end of the session, I hope it'll propel you to at least think of the last question. Do I need to change my current asset allocation? So when we typically, these are the things that I've observed. So when we go through the assets that when the client shares details with us on that they've done all this, um, typically for something like an FT, many of them say, I understand only this investment. It's simple, it's easy. Many say that it's the safest. Again, it's the same thing. You may have done it for your tax savings. You read somewhere about it, or you think it gives you the best returns. If you see between 21 and 22, there was such huge inflows into SIPs. Why? Because people started reading many without understanding how it works. People started reading how equity markets are doing extremely well and got into the markets. So a lot of SIPs, lot of new accounts were opened, lot of demat accounts were opened. So you may have just read about it, or you hear say from friends. And sometimes family also advises, buy gold, buy this property. So there could be many reasons why your decision to purchase a particular asset would have happened. What made what So the thing that you need to question yourself is, was it done because of fear or greed, or was it a random and a structured decision making? Which was the more dominant emotion while you did this? Was it just a desire? Was it a random investment? Was it a planned approach? Was it a fear that things may go wrong, or was it understanding and patience? It's a combination of a lot of things that go into it. These all seem theoretical, but we all actually do all this. Um, in the recent meltdown in the markets, so many clients ask, should I take out everything, keep it in FD, and then when the market's correct, should I put it back? Can we time the market? No, we cannot. But what has to grip them? It is fear. So what do they do at that time? They try changing their asset allocation instead of being patient. Desires. Maybe you can't afford that big car. I'm just giving a random example. You can't afford that big car. You should be pushing it by a few more years because some of the core goal is getting affected, but you go ahead with it. That would again affect your asset allocation. So these psychological factors do play a part. So give it a thought. The intent is to just make you think about all this. So when you see your asset allocation, we will get down to numbers and try showing you illustrative examples. There are four things that you need to ask yourself every time with respect to your strategic asset allocation. And again, I'm repeating, when I say strategic allocation, what we actually mean is when you're doing your financial planning and your intent is only to more than earning returns, it is to risk adjusted return should help you achieve your financial goals. So the first question you need to ask your is, given the risk, is the risk adjusted returns helping me with compounding? You may not earn, when we say risk adjusted returns, it may not be the best returns. So some other investment avenue may be giving you 35-40%. Your risk adjusted returns may be giving you 15%, but the stability factor may be more. You may be better hedged. Okay, so your base every year would be improving. 10 becomes 20, 20 becomes 30, 30 becomes 50, 50 becomes 70. Maybe for another investor who does not follow this kind of risk adjusted return approach, 10 may become 90, 90 may become 40, 40 may become 70, 70 may become again 30. So is your approach should be, is there a risk adjusted return helping me with compounding? Second, is my asset allocation most tax efficient? Many people have maybe 30-40% of their total investments into FDs. They may be having it in properties. So what is the impact? FDs are taxed. The interest is taxed. So post-tax you get only 4.5%. That would again bring down your thing. So if 40% of your investment has a taxation component to it, maybe you need to rethink and keep it into another avenue where you're not taxed at least till you redeem it. If you're going to lock up a lot of your money into property, what would happen? We would come to that point also. Third is inflation. Am I earning negative or positive returns after factoring in inflation and taxes? This is something you should ask every time you make an investment. Is this investment, given the time horizon that I should be investing in, helping me earn more than inflation and taxes? If the number is more than zero after you do this, just for an example, if you put into equity mutual fund and you think you'll get 10%, post tax maybe around 8%, post inflation even assuming the highest 7%, you'll still get maybe 2% more. You'll be left with about 2% delta. So your question should always be with every investment and your asset allocation is it overall helping me to earn more than inflation and post tax? Finally, liquidity. Very important. We cannot afford to have, each one of us circumstances are different. Our story is different. Our goals are different. So we may need money in the short term, in the medium term, in the long term. What is the mix of assets that we have so that we also have a liquidity comfort? I may need money for 4 years down the line for maybe some child, some course, education, some activity that I would like my child to go through. Do I have funds to, should I exit some property to do that? So understand how, whether your asset allocation gives you that liquidity comfort also. So these are very important things when you look at your asset table. I will show you a sample asset table. First is, what is the overall returns? Second, is it most tax efficient? Third, inflation. Is it helping me beat inflation? Fourth, does this have a liquidity comfort? So I'm just touching upon the different 4 points. So risk return trade-off we saw, we know this, we are quite familiar with this. Cash and cash equivalents or the savings bank account would be the most safest. Low risk, low return also. So this is just a grid that shows you how the risk and returns chart is placed. Something like in equity funds, risk is high, return is also high. On the highest scale would be probably private equity funds, venture capital funds, or AIFs, where the risk is very high, but returns also could reward you accordingly. So understand the risk return, risk adjusted returns that you would be getting in for each investment. This table, I'm sorry, it may not be clear. We'll be sharing the PPT, but it would we request you to clear. This just gives you the tax component for different asset classes. Nothing has changed in the last budget, barring a little small tweaking in the debt mutual funds category. So one important development that happened since 2023 budget is debt mutual funds are no longer as tax efficient as they used to be. Earlier, as an allocation, we used to definitely recommend debt. We still do for low risk investors. It's just that they've lost that tax benefit that they used to have. Like you, long term debt mutual funds, someone holding it for more than 3 years, you at least used to get indexation benefit. Now you no longer get that thing. It's taxed at your marginal tax slab or your normal tax slab rate. The good thing that the government has done, in our opinion, is that they have aligned for all asset classes the long-term rates, long-term capital gains tax rate at 12.5% and the short-term at 20%. So they've aligned it, they've made it uniform. So now your decision to buy a particular property or an asset will not be driven by the taxation part. It will be more a structured approach based on what is your requirement. That's a very good initiative and development by the government, I would say. So they're aligning of rates. So now it's your duty to decide, should I be keeping it in equities, because it does not matter whether it's equities or thing. Your long-term tax rate remains the same. Third is inflation. This just gives you the last 10 years inflation chart. Food inflation, of course, has been very high, but broadly we have been in the range of 3.9 to something like 5.1%. These are 3.9 is housing inflation. The correct number to take would be a general inflation number. I think now we have come down to around 4%. So make sure whatever investment you do, post-tax, post-inflation, as I said, should be zero, but it should definitely be covering the inflation part at least. A good example here, I just happen to remember now, is our rental yields. Our rental yields are around 4%, 3 to 4%, depending on the city. So post-tax, if you're in, it's in the margin, assuming you're in the 30% tax slab, you will be getting around 2%. You need to think, is this me buying that additional house to get a rental income? Is it going to help me cover inflation post-tax, post-return? Unless you reinvest that rental income and you earn another 7 to 8%, it may not be a very wise investment to make. Okay, this is just an example. Finally, liquidity spectrum, as I mentioned, this is the spectrum for how liquid or illiquid an asset is. Real estate is the most illiquid. Commodities is somewhere in between. The most liquid would have definitely be your savings bank balance or your mutual funds or your stocks. So you should ensure that you have a mix to see whether this is giving you enough liquidity in case of some emergency or in case of any other goal in the medium term. Should I take out a big physical asset like real property and liquidate it, or I can just withdraw from my mutual funds? So now that we have understood what the profile of the different asset classes, how they work, what are the questions you need to ask yourself, the next is aligning your risk profile to asset allocation. So first is, as an important step, understand your risk profile. So you may be a very conservative investor or a moderately conservative or a very aggressive investor. Try evaluating this about understanding this about yourself, because a lot of your decisions is based on that. If you're somebody who feels who has that peace of mind by just putting most of their money in FD, so be it. Just be aware that everything has a consequence. Okay, we will understand how that why we are saying this in one of the later slides. Understand the risk profile of the investments. Basically, you need to match your risk profile with that of the thing. So this chart also says the same thing, how the risk return trade-off of the different investment avenues. If you're somebody very conservative, can you put your money into a private equity investment or an AIF? No, you would be more comfortable putting it into gold or an FD, or keeping a major chunk of it in a bank, kind of a savings bank account. So that's a call you need to take. Whatever you do, there's nothing right or wrong. It should match your risk profile. It should give you peace of mind. It should help you achieve your goals. And you should know what is the corpus that I need to build on. That is the most important thing. So this is a typical asset allocation. Good if you can also do this for yourself. List it down on how much each one has. So if you see some two people, today's Women's Day, so I decided to put all women's names, Sita and Geeta. So Sita and Geeta both have 2 crores as their total corpus as on date. But for the same 2 crores, Geeta is able to earn 6.31% overall returns on her assets, but Sita gets about 5.76%. This may seem only some 0.5% more difference, but that 0.5% over a 30-year time frame makes a big difference in the overall returns, overall corpus that you would be accumulating. Keep that in mind. It's very important. A good number, if our inflation is at 4%, your your corpus on overall returns at the overall returns on your this kind of a corpus, all the assets put together, you should make sure you put everything. If you have 2 lakhs in your savings bank, put that also, because you should know that that savings bank 2 lakhs is fetching you only 3%. If you have 5 lakhs in PPF, put that. EPF, how much? Both your EPF, VPF, everything. Put what you have in mutual funds. You can put your physical gold also. You can put your sovereign gold bonds. Put everything. That will give you a very good perspective on where your money is gone and how much am I acting. It's a very simple exercise. Just calculate the percentage and put the expected returns that you think and take a weighted average. It's a very, very simple exercise, but it'll be an eye opener. Many of them who are very well off, very comfortable, are doing well, seemingly doing well in life, may have accumulated a lot of properties. But when they see their overall returns, it's not that they may face issues financially, but the entire objective of us working so hard, investing, is so that we earn more, we manage to earn that alpha, manage to earn that extra returns. Look, many of them will be surprised to find out that their overall returns on their assets is only about 5.5%. They are like, but I've done so much. Yes, you have done. There's no doubt about it. It's not that you have not worked towards your investments or you're not put in the effort. Where you have is where you probably need to rework on. That's the whole beauty of this asset allocation exercise. Please do it, however small. Even if you're a new person, just entered the workforce, start doing this as an exercise and keep reviewing this. This gives you a wonderful perspective. Your return on overall assets is should be at least 2%, 3% more than the inflation rate. Only then will you build a long-term corpus. So please spend some time and effort doing this. So let's get down to an actual example. Today's Women's Day. So I've selected 5 women with different risk profiles: L, LM, M, MHH, low risk, moderate to high risk, and very high risk. So this is broadly I've kept the asset allocation very simple just for us understanding purpose. So somebody like Miss L, who has a very low risk, has most of her assets into fixed income or debt kind of products, almost 67%. She does not have anything into commodities, and equities is about 15%. She is able to earn about 7% on her overall returns. Come to Miss Moderate, Miss M. She has close to about 47% into equities. She has an exposure to commodities and about 25% into debt and hybrid thing. A good example of a hybrid investment is our NPS, where we have the option to choose between equities and debt. Coming to Miss H, who's high risk, she has almost 80% into equity, so her returns are also higher on her overall assets. She's able to earn 11%. So these are women, all 30 years, with different risk profiles and earning different rates of return on their overall assets. So we'll just check how much they need to do for two very important core goals of their life. So for simplicity's sake, all of them have two kids, C1, C2, child 1, child 2. One is 6 years, one is 3 years. Both the children need 20 lakhs today's cost, 2025 cost. But when they turn 18, what is the corpus that they would need? Assuming education inflation is at about 8%, the first child would require about 50 lakhs when he or she turns 18, and the second child would require about 63 lakhs. So today's corpus, assuming 8% inflation, will be 50 lakhs and 60 lakhs when both the children turn 18. So all these women need this much money. All of them have the same age group children, and all of them have the same aspiration in terms of the child's education. So if you work backwards, if Miss L is going to get only 7.3% on her overall returns or across all her investments, the amount of monthly investment that she would need to do will be 23,000 and 29,000. Okay. So that comes to almost 52,000 per month to be spared, to be allocated for her children's education. The kind of corpus that she needs to work on a monthly basis would be much higher, is almost 52,000. Come to Miss M. Miss M will have to do a total of about 45,000 and Miss H will have to do close to about 42,000. So the basic point that we are trying is, depending on the overall returns on your asset allocation, you may need to do more or less in terms of allocating resources to it. Okay. So your asset allocation, if I'm getting 7%, oh, I need to keep aside at least 50,000 so that I can ensure I have a 50 lakh and 60 lakh corpus to meet my child's education. But Miss M can tell herself, I need to keep aside 45,000. Miss H can tell that I need to do 42,000. So depending on the risk, your asset profile, your returns are determined, which in turn will determine how much you need to do every day. Same for retirement. If Miss L is going to get only 7%, let's understand the basics first. So assuming all these women want to retire at the age of 60, they are 30 years right now. We are assuming inflation, moderate inflation of 5%. They all need 50,000 today's cost. Okay. So what will 50,000 assuming 5% inflation be when they turn 60? It will be about 2,16,000. Assume we take a life expectancy for all of them till they are 85. So how much? If my returns are going to be only 7%, I need a higher corpus to see me through at the age of 60 so that I'm able to live comfortably till I'm 85. So L will require 4.71 crores. But Miss H, who's of an aggressive risk profile, will need only 3.21 crores corpus at that point in time because she's ready to take that higher risk, right? So each one of us have a different story. I'm not saying L should become H, H should become L. I'm just saying understand how much you need. These numbers may not seem very clear to you. Approach your financial advisor or approach someone to clarify them for you in case you find it difficult to understand. The whole point being said is have a sense of the overall returns on your assets. That will speak a lot about how much you need to do for each goal of yours. So the driving point which I'm trying to say is, there are many that you may have short-term goals, you will have long-term goals. So short-term goals may be that nice upgradation in terms of a car, or you want to renovate your house. Long-term goals could be retirement, your children's education. So there are some goals where you may have to step out of your comfort zone and take a higher risk. Like somebody who's investing only into FDs. In the previous example, we saw someone like Miss L. She needs 52,000 if she wants to meet the aspiration of providing this kind of an education for both her children. Can she afford that 52,000 only to spend for this goal? Is something she needs to ask herself. So, like that, for retirement, can she afford to be so conservative and not take little risk? If she has close to about 30 years time ahead of her, so maybe she has that time. So she can, for these two goals, take a slightly higher risk. This is a beautiful image. If I would request all of you to try understanding it. So while you may inherently be of a low risk kind of a person, sometimes you need to step out of that comfort zone. So for a financial goal, it's an amalgamation of what is the risk, your risk capacity, the risk that is required to be taken, your risk attitude. It should be a combination of all that. You should be flexible to move for at least for some goals thing. Especially for long-term goals like your children's education thing. If your child is only 2 or 5 or 7, you still have time to build that corpus. So at least for some goals, maybe you need to step over. For other goals, if you're not ready to do that, just be aware that you may need to work harder with your money. That's it. There's nothing right or wrong about anything. It's about understanding your asset allocation. So finally, once you know what is the overall returns, what is your goals, try matching your investments with those financial goals. If there you have an employee provident fund, many come and ask, can I want to buy a house, can I sell my, can I redeem my EPF? I tell them, see, when you're closer to retirement, taxes would pinch you more. Have at that point in time investments which will be tax free for you. Try not touching you. You're getting 8.25% tax free investment. Brilliant. How many of us are lucky to get that kind of a corpus? So keep EPF for retirement, keep these mutual funds for child's education, keep that FD for that house renovation. So it'll give you a much more structured approach. For this medium goal, I can look at these debt instruments. For this goals which are maybe 7 years down the line, I can look at hybrid ones. For the long-term goals like my retirement, I can look at pure equity kind of investments. Gives you a more structured approach. So what are the questions that you finally need to ask? With the current returns profile, will I be able to invest the quantum required? So you need to do 50,000 for your child's education. You need to do 20,000 for your retirement, 70,000 out of my net take home. How much can I do? Can I do it or not do it? I'm just throwing numbers randomly as they're coming to my mind, but these are questions that you need to ask yourself. Do I need to change the mix of assets? Like what I said, you may have to step out of your comfort zone. Some part of your allocation should be into pure risk, high return, regulated investment avenues. I meant regulated, high risk, high return investment avenues, so that you're able to build a bigger corpus. Is the mix between my financial and physical assets optimal? Is too much into property that if tomorrow some emergency comes, I'm not able to liquidate something? Please ask yourself, very important question. Is the asset allocation tax efficient and helping me beat inflation? If you're putting too much into FDs, something like FDs, remember that FDs are not tax efficient. They give you that sense of comfort and security. They are good in a very recessionary kind of frame. Good to have part of your allocation to FDs. I'm not saying take out everything, but understand the consequences of putting too much money into FDs. Okay, please ask these questions to yourself when you put down your assets. Is it helping me, actually helping me in on an overall scale? You don't need to earn the best returns. Very important. You need to earn good risk adjusted returns to beat inflation and tax. So a very important component of understanding our asset allocation is to understand the psychology behind it. A lot of us, each individual, we tend to look at money very differently. Okay, we don't have the same approach. Our circumstances are different. We come from different family backgrounds. how the economy is doing well, the kind of information that we get to hear, the kind of government policies, the kind of initiatives, everything plays a role and part in what decisions we take. So when you're investing, please just check yourself whether it's a preconceived notion or thing. There are so many investors who we have come across during COVID time, and that market crashed. They just blindly exited. They got scared, they exited, and then they said, we will never look at it. And then we know what happened. Markets had a huge run up. You could have really made a lot of money. So it was probably about understanding this fear of yours, this bias of yours that I will not touch it. Maybe that requires a shift, that requires some rethinking on the way you would look at it. So you will have behavioral biases. You will like some asset class more. You may like property more. You may like gold more. You may like, you're very comfortable with fixed assets. That is a given. That will be there. But is it helping you or something? You need to think. So some sounding boards, again, which you need to keep a check in as part of your asset allocation processes. Power of compounding. Any investment requires time. We know people who led a good life, led a simple life. Even their EPF corpus is good to see them through to the entire life expectancy, but that's because they didn't touch that EPF corpus. They allowed it to grow, they allowed it to compound. Okay. Anything requires compounding. These are two beautiful examples of two stocks. Nvidia is a little dated stock. The prices are corrected right now, but somebody who had really had conviction in an Nvidia's kind of a stock had to wait for a really long time to see kind of returns. But when he or she got the returns, it was simply brilliant. Similar is Page Industries, an Indian company, where for a very long time it was around 350 to 1,000 kind of a range. Today it's close to about 35,000 plus. So these are things, some things take time. Some things grow, the growth is more linear. It may not take such a long time, but compounding is a beautiful miracle. Some part of your investments, you should give it that time. Battle between want and need. A lot of our asset allocation, we will grapple with this question. Should we push the car by 2, 3 years, or should I save for this? Many of us get tempted and say, I should also live my life. Let me do this. Let me just go ahead for this purchase. Maybe a car, maybe that jewelry, maybe whatever luxury, maybe that dream vacation. It's a choice you make. So try striking a balance between your want and need. That determines a lot of your asset allocation. You will pay the price. You will pay the price. Maybe life may be a little more boring, but it may give you a lot more peace of mind at a later stage. So at every stage, your asset allocation, you will keep grappling with these questions. Important, especially for those who are starting their journey, differentiate between true wealth and being rich. You may have money, but it's not equivalent to spending that money. Okay, there are better ways how you deploy it. Aim for long-term financial security and look whether it's good debt or bad debt. Personal loans, car loans which are very high, they're not necessarily good debt. Try closing them fast. Home loans are good debt. As a percentage, they do reduce as part of your percentage of your overall income. Understand all these things before you get into it. There will be black swan events. We are seeing this market meltdown. It's scared a lot of people. Our advice would only be that we have seen such markets ups and downs. The beauty of this entire journey is to stay invested. Loss is permanent. Once you let fear overtake you and you exit, that loss is permanent. But if you stay invested, the gains could be much higher than what loss you have incurred right now. So there will be black swan events in case your part of your allocation is into equities in any product form. So be patient, stay invested till you meet your goals. It's not going to be a one-way ride. Try not being too pessimistic in your investment journey, just like life. There will be volatility, there will be ups and downs. Avoid quick rich schemes. The lot of warning on influence. There are many good ones. There are okay ones. There are people who give you trading tips and all that stuff. use your own discretion, use your own judgment, try using your own skills to arrive. You may go wrong, but it's still worth it. Don't jump into something just because somebody is telling you. So be careful on all these common things. One size fits all approach. Try avoiding the herd mentality. You need to know your background, understand your circumstance, your goals, your asset allocation, and take a decision. Try avoiding the herd mentality kind of approach. So that brings us to the end of the session. I hope you found it useful. So the next time you wish to think about a goal, about a financial goal, review your asset allocation, review your age profile, review, see your income, understand how you can realign if required. Some of you may not need to. So, but do this regular review exercise once every 2, 3 years to see if there is something that you need to correct. Having a basic framework for an asset allocation definitely helps you. We are so busy in our regular careers, we don't have the time to look at it on a daily basis. So having putting in that effort to have a basic framework initially would definitely help you. So I hope all of you found this session useful, and I would be very happy if you all of you get back to your numbers and have a look at it. So very quickly, I would like to introduce my organization to you. We are a 21-year-old investment advisory firm, wealth management firm, headquartered in Bangalore, but we have branches in all key cities in India. We're close to about 80 people. And if any of you would like to reach us, my colleague Tara is there. You could write to us over the website, or reach Tara, or put your details on the chat box, and we'll be happy to get in touch with you. So these are my credentials in case anyone would like to reach me directly, or you could reach Tara also. So thank you very much. Happy Women's Day again.